In 2026, some of the most important activity in crypto is also the least exciting to watch. There are no flashy dashboards, no meme narratives, and no overnight price explosions. Instead, large financial institutions are moving familiar assets on-chain. Bonds, funds, credit instruments. These are known as real-world assets, or RWAs, and they represent one of the largest structural shifts happening in financial infrastructure today. Welcome to the Crypto IQ. Today, we're breaking down why Wall Street is paying attention to asset tokenization, how a traditional instrument like a treasury bond moves on-chain, and why banks see this technology as a solution to a growing liquidity problem. Real-world assets refer to traditional financial instruments that exist off-chain but are represented on a blockchain. This can include government bonds, corporate debt, real estate interests, commodities or fund shares. The underlying asset does not change. What changes is how ownership, settlement and transfer are recorded. Tokenization creates a digital representation of the asset that can be transferred, settled and tracked using blockchain infrastructure. This does not replace legal frameworks. It integrates them with programmable settlement. Consider a short-term US Treasury bond. In traditional finance, it is issued, held through custodians, settled through clearing houses, and traded during limited market hours. Settlement can take days. Access depends on intermediaries. When tokenized, the bond is held by a regulated custodian, but ownership is represented on-chain as a token. That token can be transferred instantly between approved participants. Interest accrues automatically. Settlement happens in near real time. Nothing about the bond's risk profile changes. What changes is efficiency, fewer intermediaries, faster settlement, better transparency. This is why institutions care. Modern financial markets are liquid in theory, but fragmented in practice. Assets are locked in systems that operate on different timelines. Collateral moves slowly. Capital sits idle while waiting for settlement. Banks face increasing pressure to optimize balance sheets. Regulatory requirements are tighter. Capital efficiency matters more. Tokenization addresses this by allowing assets to be moved, pledged, or settled instantly within defined frameworks. On-chain assets can be used as collateral without waiting days for confirmation. This improves liquidity without increasing risk exposure. This is not about speculation. It is about plumbing. Large asset managers and financial institutions are not experimenting with RWAs to chase trends. They are testing infrastructure. Tokenization reduces operational costs, lowers reconciliation overhead, and improves auditability. Blockchains provide a shared ledger. Everyone sees the same state. This reduces disputes and manual processes. For institutions managing trillions, small efficiency gains compound. In 2026, this is why tokenized funds, bonds, and credit products continue expanding quietly while retail attention focuses elsewhere. Over the next 5 years, tokenization is likely to expand gradually, not explosively. Initial adoption focuses on low-risk, high-volume instruments like treasuries and money market funds. From there, more complex assets follow. Private credit, real estate funds, structured products. Regulatory clarity will shape the pace. Jurisdictions that provide clear frameworks will attract early activity. Others will lag. This migration is not all or nothing. Traditional systems will coexist with on-chain rails. The shift happens asset by asset, desk by desk. RWAs connect crypto to the existing financial system. They bring real cash flows, regulated participants, and long-term capital on-chain. This changes the risk profile of crypto infrastructure. The value is not in speculation. It is in settlement, custody, and coordination. Crypto becomes less about replacing finance and more about upgrading it. Real-world assets are not exciting. They are not designed to be. They are designed to move trillions efficiently. In 2026, the biggest shift in crypto is not happening on social media. It is happening in back offices, compliance departments, and settlement systems. This is how Wall Street moves on-chain. Subscribe to the Crypto IQ, as we will come back again with another interesting topic.